With interest rates higher than they've been in over 15 years, one of the only ways that commercial real estate deals are getting done right now is through existing loan assumptions, where the buyer of a property is able to assume the existing mortgage and take the place of the seller to service the remaining debt. On the surface, loan assumptions can look like huge opportunities for buyers right now to increase cash flow and returns on a deal at interest rates we haven't seen in over 2 years. However, the interest rate alone doesn't paint the whole picture when it comes to assumable loans, and in this video, I want to walk through what a loan assumption is on a commercial real estate deal, some key things to consider when assuming an existing loan, and some of the downsides you'll want to factor in when going this route in today's market environment. So to step back and first define what a loan assumption is, this just refers to the process by which a buyer of a commercial property takes over the existing mortgage from a seller instead of going out and originating new debt. When this happens, the buyer of the property also takes on all the rights and responsibilities of the seller related to that loan, including paying monthly loan payments, abiding by all loan covenants, and paying off the loan in full at the time of loan maturity. In commercial real estate, assumable loans tend to be most common on CMBS loans or commercial mortgage-backed securities, or agency loans, so Fannie Mae or Freddie Mac loans on multifamily properties specifically. And because interest rates have more than doubled over the last 3 years, assuming a loan has become a really popular option to get deals done, with this often being seen as a win-win scenario for both a buyer and a seller. From a seller's perspective, offering a loan assumption will often allow them to command a higher sale price in the market, while also potentially being able to avoid a costly prepayment penalty that would otherwise reduce net proceeds and returns to investors. And from a buyer's perspective, assuming a loan allows them to lock in an interest rate that might be 200, 300, or even 400 basis points lower than the interest rate that they could get on a new loan in today's lending market. However, just because a loan offers a lower interest rate doesn't necessarily mean that these deals are automatically home runs for buyers, and these types of transactions can also have some downsides that are definitely worth considering. And the first potential downside for a buyer is that in many cases, sellers will expect buyers to pay more for deals with assumable debt than they would for comparable properties that are offered free and clear. This can often result in a buyer paying a below market cap rate on a deal solely due to the terms of the loan itself and a purchase price that's significantly above where the deal would trade in the market without that debt in place. This ends up making investors extremely reliant on interest rates coming back down by the time they either need to refinance or sell a property outright, creating very similar situations to investors that bought properties in 2020, 2021, or early 2022 that might be struggling right now to refinance or sell. And when a loan is assumed, the term remaining on that loan is also usually going to be significantly shorter than what the term of a new loan would have been if the buyer didn't assume the existing debt, which also brings that refinance risk closer for a buyer if rates don't end up coming down or even end up increasing. And even if there is a significant amount of term remaining on the debt, one of the most valuable tools for investors to increase cash flow on a deal is maximizing a loan's interest-only period, and in many cases, an interest-only period that was originally offered to the seller will have either partially or even fully elapsed by the time the assumption occurs. According to CBRE's Q4 2023 US lending figures, in the fourth quarter of 2020, only 34% of loans were full-term interest-only, meaning that the majority of commercial real estate debt originated at that time had only a partial term IO period or no IO period at all. And even though a buyer might be assuming a loan at a significantly lower interest rate than they would have been able to get on a new loan in 2024, if the majority of these loan payments on that assumable debt include both principal and interest portions, this may actually make debt service even higher on the existing loan than it would have been on new debt with an even higher interest rate. If an assumable loan had an interest rate of 4%, which is significantly lower than today's rates, usually hovering around 6% on many loan products, if we assume a standard 30-year amortization period, the loan constant on that loan would be 5.73%, meaning that the annual debt service on that loan would be 5.73% of the original loan balance. And if a buyer could either assume this loan or finance the acquisition with a new loan at a 6% interest rate, but with an additional 2 to 3 years or more of interest-only payments and more flexibility on terms overall, this might actually make the new loan an even more attractive option for the buyer of the deal. In an assumption scenario, the upfront equity requirement of a borrower is also usually going to be higher than what it would have been with a new acquisition loan, usually due to an increase in property value since those proceeds were originally issued and the loan being paid down by the seller over time, which tends to be a significant downside for investors raising third-party capital through syndications or funds. And to use an example to put some numbers behind this, if a property was purchased in the beginning of 2021 for $10 million, financed with an assumable 65% LTV loan at 4% interest with a 30-year amortization period, at the end of 3 years, the outstanding balance on the loan would be just $6.14 million, and annual debt service on the loan would be just over $372,000 per year. But if the value of the property increased by 25% over the last 3 years, and the property owner was now selling the deal for $12.5 million, if a buyer were to assume the existing loan, this would make up just 49% of the total capital requirements before including closing costs related to the transaction. And in today's market, where according to CBRE, multifamily LTV ratios in Q4 of 2023 averaged out to 63.1%, a new loan would result in over $1.7 million of additional loan proceeds to fund this deal and would reduce the equity raise necessary for the buyer by over 27%. And because that original loan payment would also stay the same on that original loan, even if a buyer were to finance the deal with a new loan at that same 49% LTV ratio to just replace the existing debt, assuming a 6% interest rate, but with interest-only payments, this would result in annual debt service of just $368,000, which is even less than the $372,000 of annual debt service on the existing 4% loan. Loan assumptions can also add additional fees to a deal, which can make the equity requirement even higher for buyers in these types of scenarios. And by assuming an existing loan, a buyer also loses any flexibility on terms related to things like guarantors, prepayment flexibility, or reporting requirements to the lender on a monthly or annual basis. Ultimately, while loan assumptions can improve the economics of a deal at the right price, these can often have unintended downsides for investors, and even though a lower interest rate can look great on paper, it's important to factor in all terms of an assumable loan, including total loan proceeds, monthly debt service, and the risks you'd be taking on at the time the loan matures. And if you want to learn more about the concepts we talked about in this video, like the loan constant, prepayment penalties, and how to model commercial real estate debt in Excel, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on different debt terms or commercial real estate loan products in general, make sure to hit the like button and let me know. And let me know in the comments where you think interest rates on commercial real estate loans are going to go throughout the rest of 2024. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.